If you wait until the world feels safe to build wealth, you will spend your life paying retail for assets other people were allowed to buy wholesale. That is the first truth. The second truth is more uncomfortable. Most people do not miss life-changing wealth windows because they are poor, stupid, or unlucky. They miss them because their nervous system was never trained to recognize a sale when that sale is disguised as danger. I want you to sit with that for a moment in ordinary life. When something valuable goes on sale, people feel excited. When the best coat in the store is marked down 40%, nobody calls it a financial emergency. When a house in a great neighborhood is suddenly cheaper, people call it an opportunity. But when productive assets go on sale, when public markets, real estate, and businesses are repriced by fear, suddenly the exact same species that loves a discount everywhere else begins calling the discount a warning. That is because markets do not test intelligence first. They test emotional structure. And if your emotional structure is wrong, the bargain can stand right in front of you wearing a bright yellow clearance tag, and you will still experience it as a threat. That is why once-in-a-decade wealth windows are missed by almost everyone, not because the window is invisible, because fear changes what people think they are looking at. They are not seeing a repricing, they are seeing a verdict, that confusion is expensive. I have spent enough years around capital to know that the largest differences in lifetime wealth do not usually come from genius stock picking, secret information, or one lucky trade. They come from a handful of moments when the world became emotionally unusable for most people and financially usable for a smaller group who had already built the correct operating system. That is the phrase I want you to remember: operating system. The average person thinks wealth building is about finding the right asset. The serious investor understands wealth building is about building the right internal system before the asset is offered at the right price. Because once the price shows up, your character moves faster than your analysis. If your system is weak, you will freeze. If your system is built, you will act. That difference compounds harder than almost anything else in markets. Now, I want to tell you what I think this period really is. Most people will call it a slowdown, a correction, a rate cycle, a policy transition, a repricing, a mess. I think those phrases are all too soft. I think what we are living through is a transfer window. A transfer window is the phase when ownership begins migrating from the people who need emotional safety to the people who built structural patience. That is what a downturn really is. It is not merely a period of falling prices. It is a screening device. It asks a cruel but very useful question: who can still think clearly while the crowd is pricing good assets, as if time itself has broken? That is why I never start these conversations with optimism. Optimism is too cheap. I start with diagnosis. The real disease is not that markets fall. Markets have always fallen. The real disease is that most people built their wealth behavior inside a period where liquidity was generous, rates were low, and the consequences of emotional mistakes were often forgiven by time and policy rescue. That environment made people intellectually sloppy. It taught them the wrong lessons. It taught them that price always comes back quickly. It taught them that if they simply wait for things to feel safe, there will still be plenty of upside left for them. It taught them that fear is a signal to stand down. It taught them that their main problem in life was opportunity, when in fact their main problem was behavior. That is why so many people are about to miss what I think is one of the best wealth. Building windows of this decade, they still have a bull market nervous system inside a repricing environment. And that is like bringing a beach umbrella into a hurricane and calling it preparation. Let's put how we got here in the language that actually matters. For years after 2020, the world was flooded with money. I do not say that as ideology. I say it as plumbing. The money supply exploded, rates collapsed. Credit was cheap, assets floated. When money is almost free, almost everything looks smarter than it really is. A weak business can borrow. A speculative asset can attract another round of believers. A ridiculous valuation can survive because the discount rate is too low to punish fantasy. That is what easy money does. It blurs the line between worth and price. Then inflation arrived with enough force that central banks had to reverse the trick. Rates rose, cheap money ended, and once money stops being cheap, the market remembers a truth it had been trying hard to forget. Everything has a carrying cost. Every business, every house, every balance sheet, every dream. And when the carrying cost rises, assets that once looked inevitable suddenly become conditional. That is what people are calling pain right now. I call it the return of arithmetic. The first mechanism is what I call the price reset. This is the part the crowd feels immediately. Stocks drop, crypto gets humiliated, speculative growth companies that only made sense inside a zero-rate hallucination come back to earth, Real estate stops behaving like a one-way escalator. Long-duration bonds, which many respectable people thought of as boring safety, reveal themselves to be much more fragile than their owners realized. Everybody calls this destruction. I do not. I call it price finding. The market is asking an overdue question: what is this thing actually worth in a world where money is no longer free? That question feels violent only because too many people had stopped asking it. The second mechanism is the fear gap. This is where wealth begins separating from noise. Most people think they miss great opportunities because they lack money. That is not usually true. They miss them because the best entry points occur in emotional conditions they have not prepared to tolerate. There is a reason the best long-term returns often begin inside the ugliest short-term headlines. Because fear is what creates the discount. If the environment felt calm, the discount would already be gone. This is what the ordinary saver struggles to accept. He wants the opportunity and the emotional comfort at the same time. He wants to buy cheap, but he wants to feel socially validated while doing it. Markets do not usually offer that combination. They offer one or the other. The third mechanism is the time window. This is the part everybody gets wrong because they keep imagining opportunity as a dramatic one. Day event, it rarely is a once. In a decade window is usually not one day. It is a stretch of months or a couple of years in which the repricing, fear, and forced selling create repeated chances to buy productive assets at sensible or exceptional prices. The problem is that people keep waiting for a giant flashing sign that says the sale has officially started. That sign never comes. Instead, the market just gets more frightening, valuations get more reasonable, and the people with a plan keep accumulating while the people without one keep asking if the bottom is in. That is why the crowd always enters too late. They need emotional permission the market was never going to provide. Now, I want to tell you the three fields where I think real wealth is built in a window like this, because not every falling thing deserves your capital. A falling price is not a moral argument for buying. Sometimes the thing is falling because it was absurd to begin with. Sometimes the business is weak, the debt is too large, the cash flow is fiction, or the valuation is still insane even after a 50% drop. I have no interest in buying a bad business simply because it was embarrassed. That is not courage, that is romantic stupidity. So where do I think the real opportunity lives? First, public equities of quality businesses repriced by fear rather than by terminal decay. Second, real assets, especially real estate in markets where financing pressure is temporarily stronger than the long-term desirability of the location or asset. Third, human capital, which means your own income power, skill stack, and earning capacity. People talk about the first two constantly and ignore the third, which is one reason so many of them never really escape their own constraints. Let me start with stocks. The stock market is still the greatest wealth, compounding machine ordinary people can access with no pedigree, no permission, and no private banker. That remains true. But the way you use it matters. A lot of people hear me say opportunity and immediately start thinking in lottery tickets. What hot stock, what sector, what moonshot? That is not how serious wealth is built across cycles. It is built by accumulating ownership in durable businesses when other people are temporarily incapable of separating price from panic. There is a simple way to think about this. If a company has real earnings, real customers, real cash flow, and a business model that can still matter 5 or 10 years from now, then a forced repricing caused by rates, fear, or general recession psychology can turn it from an admired company into a mispriced opportunity. Those are not the same thing. A wonderful business at a stupid price is still a bad investment. A wonderful business at a rational or fearful price becomes interesting. That is why I care so much about valuation during a downturn. The crowd wants to know what is down the most. I want to know what is now priced sanely relative to what it can earn through a cycle. The average person makes this much harder than it needs to be. He does not need to predict the exact low. He does not need to find the one perfect stock. He needs a list of strong, understandable businesses or broad, diversified funds he would be happy to own for a decade. And then he needs the discipline to buy them regularly when prices are more favorable than they were before the fear arrived. That is the protocol, not theater protocol. This is where dollar cost averaging becomes more than a cliché. People mock it because it is too simple. I like simple things, when simple things are backed by arithmetic. If you invest on a schedule through a repricing window, you solve two problems at once. You stop pretending you can time the exact bottom, and you stop allowing your emotions to vote every month on whether your future matters. The crowd thinks discipline is boring. Compounding thinks discipline is beautiful. The reason the long-run numbers in equities are so powerful is not that every year is kind. It is that the market, across long enough periods, has always rewarded ownership in productive enterprise more than fear rewarded cash hoarding. The key phrase there is across long enough periods, that time horizon is not decorative. It is the whole edge. If you need next month to validate your decision, you are not investing. You are negotiating with anxiety. Now let us talk about real estate, because this one confuses people in a high-rate world. They look at mortgage rates, transaction volume, and sticky prices, and conclude that nothing interesting can happen until policy gets easier. That is not how serious buyers think. A serious buyer asks a different question. Where is financing pain creating an entry point that better rates later may turn into a windfall? That is what matters. Real estate is always a financing story wearing a location story on top. When rates are high, marginal buyers disappear, volume drops, weak hands step back, sellers get stubborn until life forces some of them into realism. That does not mean every market becomes attractive. Far from it. Some markets were insane and remain expensive. Some properties are bad assets with a nice brochure. But when a high-quality real asset in a durable market becomes cheaper or negotiable because the financing climate is temporarily harsh, that is exactly the sort of volatility I want to study. Because rates do not stay high forever. They may stay high longer than the crowd wants. They may stay high long enough to cause a lot of pain, but they do not stay fixed forever. And if you can buy a real asset at today, stress financing terms, and survive those terms, then the day financing becomes easier again, often delivers you two gifts: lower carrying costs and a wave of returning demand. That combination can create substantial value. Again, this is not about buying anything with a roof. It is about buying quality through temporary financing stress. That is the pattern, not blind optimism, not real estate worship. The same discipline applies: good location, good economics, real staying power, enough resilience that the asset does not need a perfect world to justify its existence. Now, I want to talk about the third field because it is the most overlooked, and for many people, the most decisive: your own earning power. I have met far too many people who spent years learning how to compare stocks and almost no time learning how to make themselves more valuable in the labor market or in business. That is backwards. Your first compounding engine is not your portfolio, it is your income. If you increase your earning power, you increase your investable surplus. If you increase your investable surplus while assets are cheaper, you accelerate every other compounding process that matters. That is why downturns are not merely times to buy assets. They are times to upgrade yourself. Skills behave differently in hard environments. The world does not reward every skill equally. In a tighter economy, the people who can directly help a business make money, save money, automate, sell, manage risk, interpret data, use technology productively, or solve painful bottlenecks tend to become more valuable, not less. Those are the people who get hired, promoted, or remain independent when conditions get tougher. This is one reason I tell younger people that the highest return investment they can make may be boring at first glance. A course, a certification, learning sales, learning marketing, learning software tools, learning how AI actually integrates into productive work instead of just talking about it online. That does not sound glamorous compared to buying a hot stock, but glamour is not the same thing as yield. A stronger income base can add hundreds of thousands or millions of dollars to your lifetime investment capacity. That dwarfs the effect of most clever asset selection errors or wins. So I would say this very directly: if you want to use a once-in-a-decade window properly, you should not only be shopping for discounted assets, you should be making sure the machine that buys those assets, your own earning capacity, becomes more powerful while everybody else is distracted by headlines. That is the underrated move. Now, there is a trap here I want to warn you about. People hear opportunity and assume everything down is cheap. That is nonsense. A business can fall 70% and still be overpriced. A story stock can lose half its value and still be a terrible long-term owner of your capital. The distinction is not whether the thing is down. The distinction is whether the cash generation, competitive position, and economic logic underneath it still justify ownership. This is why I prefer simple filters. Does the business make real money? Does it have recurring demand? Does it generate cash? Does it rely on cheap debt to survive? Would I still care about owning it if the market stayed unpleasant for another year? Those questions get you much farther than most retail investing entertainment ever will. The same is true for asset allocation. Do not ignore bonds just because they were dead money for a decade. One of the quiet consequences of higher rates is that fixed income once again matters. That is not a small point. For years, bonds were so starved of yield that they became almost ceremonial for many younger investors. That period is over. If you can earn a real return in high-quality bonds or treasury paper, that changes the architecture of a sensible portfolio. It does not mean abandoning stocks. It means recognizing that a balanced structure is more attractive now than it was when safe paper yielded almost nothing. That is a gift of repricing too. The crowd tends to view repricing only through the assets that went down. Serious investors look at what became newly useful because the repricing happened. Now let us get to the real battle, because everything I have said so far is still useless if you do not solve the one enemy that sits closest to you, your own brain. I do not say that to sound profound. I say it because the data on long-term wealth building is brutal. The people who fail are not usually defeated by a lack of information. They are defeated by loss aversion, indecision, and the inability to stick with a rational plan when prices get ugly. Human beings are wired to interpret falling prices as evidence of danger. That makes sense if the thing falling is a tree coming toward your skull. It is less useful when the thing falling is the temporary market price of a productive business you plan to own for 10 years. But your nervous system does not care about the distinction. It only feels red and calls it threat. That is why a system matters. You cannot expect yourself to feel calm in the middle of every drawdown. That is childish. You can expect yourself to behave correctly if the correct behavior was designed before fear arrived. That is maturity. Automate contributions, write down your investing rules. Set the percentages, define what quality means to you, define your time horizon, define what you will not do. No leverage, no panic selling, no changing your strategy because a man on television got louder. No waiting for emotional safety before acting, then sign it. Why sign it? Because the signed document is a contract between the clear version of you and the frightened version of you. That is the real operating system. You do not need more opinions during a crisis. You need obedience to your own best thinking. I also want to say something about tax-advantaged accounts because neglecting them is one of the stupidest self-inflicted wounds in personal finance. If your employer offers a match and you are not capturing it, you are turning away free return. If you are eligible for a Roth IRA and you are not using it, you are ignoring one of the most powerful long-term compounding shelters legally available to you. These things are not side notes. They are force multipliers. And when you are buying more shares at lower prices inside tax-advantaged structures, the power of the downturn compounds twice. You get better entry points and better tax treatment. That is not a tiny edge, it is a life edge. Now I want to pull the whole thing together because people get lost when they hear too many parts. This is what I believe the current environment is not mainly a reason for fear. It is a reason for structure. The sale is not yet fully over and it may get better. Good, that is not a threat. If you have a protocol, the opportunity lives in three places: reprice quality assets, real assets under temporary financing stress, and your own ability to increase the rate at which you can convert income into ownership. The people who come out of a downturn significantly richer do not usually look brave in real time. They look annoyingly disciplined. They keep buying, they keep learning, they keep upgrading skills, they keep ignoring noise. They keep letting automation and time do work their emotions would have sabotaged. That is what wealth building actually looks like. It looks boring enough that almost nobody copies it for long enough. And that is one reason it works. Now let me give you the final test. Stand in front of the mirror and ask yourself one question. If markets fell another 20% from here, would I treat that as proof that my future is ruined or as confirmation that the window is wider than I thought? Do not answer with a fantasy version of yourself. Answer with a system you have actually built. If the answer is proof my future is ruined, then the work is not to find the next asset. The work is to build the protocol, automation, and emotional architecture that turns falling prices into action rather than paralysis. That is your threshold. That is your contract with your future self. I will not demand that opportunities arrive dressed as comfort. I will not wait for the all-clear signal history never gives until the easy money is gone. I will keep investing while prices are more honest than they were. I will keep improving the machine that earns the money I invest. I will use tax shelters, structure, and time instead of hype. And I will remember that almost every once in a decade wealth window looks in real time like a period most people would rather sleep through. That is why the people who stay awake during it are so often paid for years afterward.